Ladies and gentlemen, good day and welcome to the Q2 FY24 conference call of Centum Electronics Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. I now hand the conference over to Ms. Purvangi Jain from Valorum Advisors. Thank you, and over to you, ma'am.
Good afternoon, everyone, and a warm welcome to you all. My name is Purvangi Jain from Valorum Advisors. We represent the investor relations of Centum Electronics Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings conference call for the second quarter and first half of financial year 2024. Before we begin, I would like to mention a short cautionary statement. Some of the statements made in today's call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to the management. Audiences are cautioned not to place undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now I would like to introduce you to the management participating in today's earnings conference call and give it over to them for their opening remarks. We have with us Mr. Nikhil Mallavarapu, Executive Director, and Mr. K.S. Desikan, Chief Financial Officer. I will now hand it over to Mr. Nikhil for his opening remarks. Thank you.
Thank you, Purvangi, and good afternoon, everyone. I'd like to extend a warm welcome to all of you for our Q2 earnings call. Thank you all for your interest in Centum and for making the time to join the call today, especially before the Diwali weekend. As a quick reminder, or for those of you who may be attending for the first time, Centum as a company focused on the ESDM segment offers 3 service lines: EMS or Electronic Manufacturing Services, Build to Specification or Build to Spec or BTS, which is an end-to-end turnkey service of design to mass production, and engineering R&D services. Our standalone business is comprised of the EMS business and the BTS business for defense and space customers, and our subsidiary with operations in Europe and Canada is primarily focused on engineering services and some BTS work for customers in the railway and defense sectors. Coming to our Q2 performance, our consolidated revenue was 248 crores, representing a growth of 23% year on year. We had a strong performance in our EMS business, which was a major contributor to our standalone revenues growing by 53% year on year and 25% quarter on quarter. This is the result of the production ramp-ups from new customers in the industrial and e-mobility space, as well as existing customers for defense exports. At the subsidiary level, it's a seasonally slow quarter due to the number of billable working days being lower in Europe during the summer period. Also, as previously mentioned, margins in the subsidiary have been adversely impacted due to budget overruns in certain legacy fixed-price contracts, which weighed on the performance in the current quarter as well. We are in the process of closing these out and expect the revenues and margins to pick up in the coming quarters and into next year. Our focus in the subsidiaries remains on improving the margins. On the order book front, our order book remains strong at 1,548 crores, and we are expecting some good inflows for the EMS and BTS business in the second half of the year. And in terms of sectors, the domestic defense and space business will be a major contributor, as well as some new customers in the EV space. So that's a quick summary. I will ask our CFO, Mr. Desikan, to cover the main points from a financial perspective.
Thank you, Nikhil, and once again a warm welcome to all of you. And before I begin, let me give you the best wishes for a happy Diwali ahead of us. So now, though Nikhil briefly touched upon, I will give you the details of the financial performance for the quarter. At a consolidated level, the revenue from operations is about 248 crores, which is flat on Q-on-Q, but an increase of 43% on year-on-year. The EBITDA for the quarter is about 17 crores, which is 6.9%, as against the previous quarter 8.5% and 4.1% the same time last year. The working capital remained more or less flat between 79 to 80 days, but the debt increased from 263 crores to 298 crores. This is mainly due to the increase of debt in the standalone company. Now, going to the standalone company, the revenue from operations for the quarter was about 160 crores, with an increase of 25% Q-on-Q and 53% Y-on-Y. And as Nikhil explained, this was mainly due to the growth in the EMS business. The EBITDA for the quarter was about 21 crores, which is 13.2%, as against 3.2% of the last year same time. The EBT for the quarter is 13 crores, which is significantly higher compared to Q-on-Q as well as Y-on-Y. Working capital reduced to 135 days compared to 140 days in Q4 of 23. And the debt increased from 106 crores in March to 143 crores in September, mainly due to two things. One is we had taken a fresh term loan of 15 crores for funding our capex, and the increase in net working capital is about 22 crores, which is in line with the activity levels, the increased activity levels. And coming to the subsidiary Centum C&S, as Nikhil had already explained, the performance is not okay, but we had already indicated about this in the previous earnings call. The revenue from operations was about 98 crores, which is actually 14% decrease over the previous quarter and almost flat compared to the same time last year. EBITDA was like break even. In terms of working capital, there is no change, and debt was marginally reduced from 157 crores to 155 crores. So this is quickly about the numbers and the financial performance of the company, the group, and the subsidiary. Maybe I will stop here and then you can open up the question sessions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Umang Parekh from Ashika India Alpha Fund. Please go ahead.
Hi, thank you for the opportunity. So my question is with respect to the healthcare segment. So currently it is contributing around 9% to the total revenue. So can you talk more about the opportunity here and the revenue contribution from this segment vis-a-vis the total revenue going ahead? The mix.
Sure. Thanks, Umang, for the question. So, yes, the healthcare segment today is a little less than 10% of our overall revenue base. This comes from both the engineering services as well as the EMS side of the business. We are manufacturing various electronic products for end applications like digital radiography, like X-rays or MRI machines and so as well as doing certain, some consumer health or point of care kind of devices, also on the EMS side. This is an area that is strategic to us, and we want to continue to grow. We've been working on some exciting new opportunities with some of our customers in France, actually, on, again, some point of care devices focused around telemedicine kind of applications and so on. That is right now in the engineering phase, and then we expect that to come into production in the next year, basically.
Okay.
So that's just a quick word. Yeah.
And so what would be the margin profile from this segment?
So we don't break margin profile by industry sector. We talk more from a margin profile of the service line. And so that's where we previously said, whether it's a benchmark level for EMS kind of business, margins are anywhere from 9 to 12% or so. On the build to spec side of the business, it can be 20% or more. And then on the engineering services, again, depending on various operational leverages, our short-term objective is to get to a 10-11% and then take it up further as we improve our onshore-offshore mix.
Okay, got it. And so are we exploring any other segments?
No, I think at the moment we are quite comfortable that there are some opportunities for growth in the segments that we're already operating in. So we continue to stay focused on those, and I would say that's what we're focused on.
Okay. Yeah, that was it from my side. Thank you.
Yeah, and then just to add to that,
yeah.
Specifically, as I mentioned earlier, the EV space is an area that we're quite bullish on. So we've seen a good ramp up of that in the past year, and we expect that to continue.
Sure. That was helpful. Thank you.
Thank you. Our next question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Good afternoon, sir. The first question is your operating profit margins in the first half was around 7.8%. Now, considering the order book which you have, and I understand that H2 is always better as compared to H1. So at consolidated level, what kind of operating margins you are looking at for this full year?
Thank you, Mr. Ankit. But we are saying that, with the current profile and the order book and what we have done in 6 months, we should be able to get an 10% for the company.
Okay, so actually just a reconfirmation. So for 10% full year margins, the H2 margin has to be higher than 11-12%. So that's what you are working with, right?
Yes, of course. Yes.
Okay. And sir, you were expecting some big ticket size orders in your BTS segment. So what's the status of the same, sir?
Yes. So as I mentioned at the beginning, these are still active, and it's progressing well. We were expecting actually for it to be closed in Q2, but it has slipped slightly. But we still have a good visibility and expect to close this in Q3 or at worst case Q4.
Okay, so it is just a delay in the timing of getting those orders. But you will get those orders. That is for sure.
Yes, we're fairly confident. I mean, we can never be sure until it gets there, but we're fairly confident.
Okay, and so assuming you get, so I mean, your order book levels have been constant since last couple of quarters at around 1,550 crores. So what are your targets for order book at the end of this year after considering the execution of H2?
Again, we won't give a specific guidance on order book level at the end of the year, but and just to re-emphasize again, our order book can be quite different for each of the three business units. EMS business typically you can have anywhere from 6 to 12 months of orders, whereas on the build to spec side it is 2 to 2.5 years of order booking, and then on the engineering services it can be maybe 6 months or so. So the profile of and the mix of the order book will also make an impact on what the overall order book is. But as we have said earlier, in terms of revenue growth itself, we continue to maintain that we continue to target 20% plus growth rate over the medium term.
Okay, and what was your order inflows in the first half, sir, across all the three segments?
No, again, like you only mentioned that order book has been relatively flat. So the amount of revenue that we have done is what the order inflow was.
Yeah, that's an important point, because you note that our revenues have obviously increased on a half-year basis by 21% or so. So to that extent, even our order intake has increased.
So any guidance on the full year inflow side? I understand order book you are not giving, but any color on the inflow side? What kind of order inflows are you expecting?
No specific guidance, Ankit, but as I mentioned, visibility is strong, and we're seeing some good order intake expected in the next 2 quarters.
Okay, and so last question is on the Canada business. It is still bleeding. I mean, still are we incurring losses in that geography?
It is. We've been successful in terms of continuing to move some of the work to India. Having said that, yes, it's still in a challenge. As we said earlier, there are certain legacy projects which we have to close out and deploy people on the new projects which we are in the process of doing now. So that's the overall comment I made about the fixed price project overruns at the beginning is partly attributable to Canada, and then we expect the overall subsidiary margin to improve as we go into subsequent quarters.
Okay, so I mean, I just need to understand till how much more time will you take to break it even, or to that the losses are not continuing? I mean, a couple of quarters more, or what's the outlook there?
So at the subsidiary level, we expect it to be profitable in the next 2 quarters itself. So yeah, I mean,
that is including the French business.
Yes, that's including the French business.
Okay, but Canada will continue to be negative, in particular.
We're seeing a steady improvement in the margin profile for Canada also. So.
Okay. Thank you so much, sir.
Yeah.
Thank you. Before we take the next question, a reminder to all participants, you may press star and 1 to ask a question. Our next question is from the line of Karan Sanwal from Niveshaay. Please go ahead.
Hello, am I audible?
Yes, sir. May we request you to use your handset, sir?
Sure. Yeah, it is. Is it better?
Yes, sir. Please go ahead.
Yeah, thanks for the opportunity and congratulations on good set of numbers on the standalone basis. I have a couple of questions. The first question would be regarding the macro scenario. So, in the last con call, you highlighted that we aren't facing any impact on the Indo-Canada relationship that was a bit impacted in the last quarter. I just wanted to understand what's the scenario right now for the same.
Yeah, the position remains pretty much the same. I don't think we're seeing any major impact as a result of that conflict on or that issue on our business as such. We have some engineers that are coming from Canada, some engineers going to Canada, and to that extent, there is no major disruption in our regular operation.
Okay, that's good to hear. And also the current Israel-Gaza war, do we have any impact in the ways in any raw material or revenue impact from that geography, Israel?
Again, in the short term, we are not seeing any major impact as a result of this conflict. We do work with Israeli companies. We are a supplier to customer there. We continue to see a healthy pipeline of opportunities coming in from there, even through this. And so, yeah, no major impact from
the supply chain is not affected because we don't have much from Israel.
correct.
Okay. And the second question would be regarding the increasing contribution of EMS in our business, and it's performing really well in the domestic markets, increasing in a good pace. So I want to understand would an increasing contribution on a full year basis would result in reduction of margins on a consolidated basis for Centum?
No, actually, if you had observed, there was another question last year. Our EBITDA margin was about 7.8% or around 8%, and what it would be for the full year. And I answered that it will be in the range of 10% plus, but this is factoring the EMS growth into the revenue for the current year. So obviously the margins would be definitely better than what it was last year. In spite of the growth in EMS, which is a lower margin, but overall margins will be better.
Yeah, and to just add to that, I think the most important leverage, as we mentioned earlier, from an overall group level margin right now is improving the subsidiary margin. While the EMS is growing, we also are unlocking some operating leverage there as well. So we do see some improvement coming in the margins in EMS itself. But at a consolidated level, the major leverage, as I mentioned, will come from the margin in the subsidiary.
Right. That's right. And also, in the last year, we faced the BTS revenue booking is generally in the second half of the year, and the last year we faced, we did major of the booking in the last quarter, basically. So can we expect something like that in this year, or would it be fairly split between the quarter 3 and quarter 4, the BTS segment 2 in specific?
BTS segment, yes, we'll have a slightly higher contribution in terms of both revenue and margin in the second half of the year. Having said that, this year we are not seeing a huge impact to the extent of what we saw in Q4 last year, right, where it was very skewed. This year it's a little bit more balanced. But yeah, so that's a quick thing with regard to Q4. And I think we will see some further improvement and growth in the BTS business in the next year as well.
Okay, that's good to hear. And just one last question, like we have experienced an increase in inventory if you compare in H2 versus the last year. So are we, gearing up for the next quarter and the years to come? That's the reason for increase in inventory?
Partly, yes. And, as we expect the increase in activity in second half, the increase in inventory. Additionally, in the EMS business specifically, sometimes the customer asks us to buy the inventory, which are of a long lead time cases, so that the inventory is, available when it is needed for production. So in such cases, we request the customers to pay us an advance to fund that inventory. So when you observe the inventory increase, you can also see in the liability side, the current liabilities also increase significantly, which is mainly because of the customer advance given by them.
Okay. And also, sorry, but you also can you also highlight the fluctuating gross margins? Why are we having so much fluctuation in the gross margin quarter-on-quarter basis, or maybe on year-on-year basis as well? Like, do we have any price pass on in this industry?
No, we don't have any price impact at all, because any price increase by the supplier, we pass it on to the customer. See, when we take an order, there's a bill of material where the prices are defined. And if at the time of procurement there is an increase in the price, the same is communicated back to the customer, and he gives an approval to buy that at a higher price, and we pass it on. The only thing could be there could be a time mismatch of securing the part and then incurring the cost. Maybe in the next quarter we will get that increased price revision, but we don't have an impact because of the increase in raw material prices.
And also, I think the main thing what you may be seeing in terms of gross margin is really based on the mix of the dish, because as you mentioned earlier, EMS is what is given the big growth for the consolidated level, and the contribution of EMS is higher, which is why which obviously inherently is at a lower gross margin than build-to-spec business. That will be the other reason.
Okay, thank you so much, and happy Diwali to you and your team, and all the best for the next quarter. Thank you.
Thank you.
Thank you. Next question is from the line of Vivek Kumar from Best Pals Research and Advisory LLP. Please go ahead.
Sir, am I audible?
Yes.
So you have been guiding 20% growth and margin improvement for the next 2 to 3 years. What are the risks, in the sense, how much is the risk that of the next elections or this current dispensation not going or falling, or we have other ways and other areas and other revenue streams which we can fill up and still grow? So, or any other risk that you are seeing, so if you can elaborate. Thank you, sir.
Yeah, I mean, just to summarize quickly in terms of our growth drivers, as we talked about. First of all, important to highlight that, in our overall business, about 75% of our business is coming from overseas. So, some of the growth drivers that we are seeing are a result of, either the China Plus One strategy where customers are looking to de-risk their supply chain and bring business to India, or other policy initiatives by the government itself to drive Make in India kind of opportunities. And these are sort of structural macroeconomic shifts that are happening. So we continue to see that trend continuing, and so we're not seeing any major disruptions from a demand perspective in the short term as a result of elections or anything else.
Thank you.
Thank you. Our next question is from the line of Nirali Gopani from Unique PMS. Please go ahead.
Yeah, hi. Thank you for the opportunity. So next, I'm very new to the company, and I see that you have a very strong order book. And you have been guiding for roughly about 20% plus growth and improving EBITDA margin. But historically, we have not grown at this kind of rate. So if you can just help me understand what has changed in the company or maybe at the industry level very briefly would be helpful.
Sure. So I think, as I mentioned earlier, I think first of all, from a macroeconomic standpoint, we're seeing these important tailwinds happening in the form of China Plus One or the Make in India kind of policies, whether it's in defense or in other non-defense segments as well, like industrial and so on, which is essentially driving various global OEMs as well as Indian companies to look and make in India at a much faster pace than what they have in the past. That's one, and then specifically on the defense side, which is a major contributor to our revenue. There again, there's a significant push towards Atmanirbhar. There's various opportunities which were previously intended to be global tenders or for import options are now being pushed to be sourced indigenously, and that opens up various opportunities for us. So I would say these are some of the points. And also from our own strategy perspective, we've been looking to position ourselves in higher growth segments. As I talked about earlier, electric vehicles has been one of the areas that we've been working on for a few years now, and that started to give us good benefits, I would say, in terms of the performance starting last year and much more coming into this year as well. So these are, I would say, the high-level points. Broadly speaking, good macroeconomic tailwinds, and secondly, our positioning in high-growth segments to be able to capitalize on the growth.
Just
Perfect.
Numbers, if you look at it, the 6 months number, last year 6 months we had done 410 crores of revenue, whereas this year we have done already 496 crores. So that indicates a 21% growth in the 6 months itself already. And when you look at the EBITDA at a consolidated level, for 6 months we are at 7.8% already, which was actually 4.8% last year 6 months. So now with the increased revenues and improvement in the margins in the second half, that is how we are targeting to be around 10% in the EBITDA margin. So that already in 6 months you will see some good signs of it, though, like what you said, you may not have seen in the past.
Right. And you have guided that FY24, the consolidated EBITDA margin should be at about 10%. But if I look at from a slightly longer term perspective, say 3 to 5 years, what do you feel the sustainable margins for us should be?
Yeah. At a consolidated basis, we are targeting to be in the mid-teens, basically, in terms of EBITDA levels. And that obviously will be a reflection of the mix of the business. And as I mentioned earlier, the BTS business can be at a 20% level plus. EMS part of the business is at 11 to 12% basis, and then our engineering services is the key place where, as a first step, by taking some of these steps to reduce the cost overruns and all of that, we want to bring it to a 9-10% level, and then take it up to a 14-15% level over a 2 to 3 year time horizon by various operational leverages.
Right. That's it from my side. Thank you for answering my questions.
Thank you. Our next question is from the line of Sonali Shah from MK Investment Managers. Please go ahead.
Hi. Thank you so much for the opportunity. My first question is regarding the fixed price legacy projects that are there at our subsidiary level in Canada. By when are they expected to come to a close?
There's multiple projects, Sonali. So, we closed some in Q2, and there are a couple which will extend into Q3 and Q4. But as I mentioned, we expect to see a good recovery on the margin front in the subsidiary in Q3 and Q4.
All right. Got it. And just wanted to clarify one thing. Our employee cost at the subsidiary level was actually quite high this time around. So I understand there were already some cost overruns. Just wanted to know if there are any other one-offs apart from just that, because I understand that we're doing certain onshore-offshore mix that we're kind of trying to change over there.
So, largely, your observation is right in terms of absolute numbers which have gone up. But you should also know when there is an overrun, we lose the opportunity to bill. So if we have billed, obviously the percentage would have been under control. But also the fact that what you mentioned, we are trying to increase the India headcount, but that's not a major impact. It's the impact of only the overruns.
Okay. Thank you. And just one last question. For the new orders that we're taking at subsidiary level, which are probably fixed price contracts, what mechanism would we have in place so as to prevent these kind of cost overruns? Also, if, for example, a customer changes their specifications, say, halfway through the project, how do we kind of account for it that it doesn't affect our profitability in any way?
Yeah, good question, sorry. So there's multiple things that we're doing on this front. First of all, just in terms of choosing which projects we quote or we bid on itself, we are being a little bit more choosy to take a more risk-based approach on the projects. So we're basically declining to take on projects where we perceive a higher level of risk from an execution standpoint, or working with the customer to have a mixed model of doing a time and material for a certain period of time when there is a higher level of uncertainty around specifications, changes, and so on, and then maybe migrating to a fixed price once things are more clear. That's one of the other things that we are working on. And finally, I'd say also from a leverage standpoint, we will continue to look at how we can do more of this work in India, where even if there is an overrun, the impact on the overall cost will be much lower. So various different things. And finally, project management itself. That's another area that we are strengthening within the company.
Okay. So just to kind of move this forward a little bit, as of right now, are there any contracts or are we in negotiation with any customer wherein we're kind of adopting this newer model where we sit and plan and work with them in advance and then subsequently move on to a fixed price model?
Yes, absolutely. We have a few examples of those where it was intended initially to be a fixed price contract, but we've worked with the customer to initiate this on a time and material basis and then convert it to a fixed price subsequently. Right? So but those are newer projects. For the existing ones which are ongoing, we need to obviously complete them in a way. But even in some of those cases, when the project is way over, we are working with the customer to basically convert some of them to a time and material or a service center based model where we are mitigating these overruns.
Got it. Fair enough. That's it from my side. Thank you so much and best of luck.
Thank you so much.
Thank you. Our next question is from the line of Yash Bajaj from Lucky Investment Managers. Please go ahead.
Good afternoon, team. Thanks for the opportunity. I had a couple of questions on the build-to-spec business. First is, which industries do we cater to with the build-to-spec segment, and are they domestic or export business?
Yeah. So build-to-spec, big chunk of what we do is basically addressing the domestic defense and space sector. This is where we service customers like the PSUs or ordnance factories and DRDOs, all of them. That's one part of the business that resides in our standalone entity. And then we have another part of the build-to-spec business in the subsidiary, which is basically addressing the railway segment, where we deliver passenger information systems for trains. So that's basically whenever you're on the train, the integrated system with all the displays, CCTV, public announcement, and all of that is something we manufacture the hardware for, integrate with software, and supply the full system to the train builders like an Alstom or a Siemens, or also in certain cases to the operators directly. So that's, I would say, those are the big parts of our BTS business. And that the railway part of the business is a global business. So we're delivering to metros and high-speed trains, mainline kind of projects globally.
Got it. And the build-to-spec business is a relatively much more margin-accretive business and is much more stickier. So what does the customer, what kind of capabilities does a customer look at before onboarding a supplier like us?
I would say, it's the design strength and domain knowledge are obviously very critical. And of course, the ability to have the right infrastructure from a manufacturing perspective, right? So, just to take the example of build-to-spec on the domestic defense and space side of the business, there's multiple different kind of projects or technologies that we have. Whether if you talk about it from a design standpoint, having strong experts from a RF and microwave, power electronics, digital design, all of these, and specialists from the space segment or electronic warfare, these kind of areas are something that are first and foremost critical. And in addition to that, we also have some very niche capabilities more on the space side of the segment, where we have we're able to do microelectronics manufacturing. And this is something that not many companies, probably only one other company in India have. And that again provides a unique differentiator, especially on the space and some applications in defense as well. And then on the rail side of the business, that comes down to people or design engineers who have a long history, understand the certification processes for the designs, the quality and qualification criteria from a documentation perspective. All of that is something beyond just actually doing the design itself for these products that become critical. So in most of these kind of projects, we are typically competing against maybe one or two other companies max. So.
Okay, sir.
And also add a little bit there, at a very high level. One, deep domain knowledge and engineering capabilities, as explained by Nikhil. And two, also the high-class infrastructure, which is also you require class 1000, class 10,000 kind of infrastructure and the machineries for the high-tech, high-end thing. So both these together are the real unique propositions that a customer looks for.
Okay, sir. And just one final question is there any difference in working capital for a build-to-spec versus an EMS business?
Build-to-spec and EMS
business?
So, no, build-to-spec generally, as you know, that the quantities may not be much, and also it is order-to-order basis. So what we do is when we get an order from the customer, we pretty much order the materials required for executing that order, and it depletes over a period of time as we, deliver. So in build-to-spec, the working capital levels should be slightly higher. It could be around 180 to 190 days. Whereas in the case of EMS, these are, based on the forecast given by the customer, which are converted into orders. So there is a steady visibility available, but the question here is that customers look for a credit period of at least about 90 days. So overall, the EMS working capital will be around 90 days, whereas the build-to-spec should be around 180 days to 190 days.
And the major difference is the inventory part of it and the credit part, right?
That is right. Yes.
Okay, sir. Thank you so much.
Thank you. Our next question is from the line of Pranav Bastawala, who's an investor. Please go ahead.
Yeah. Thank you for the opportunity. So I've got one couple of questions. One is what I am looking at is around we have 650 crores tied up in stock and data at consolidated level, and also a debt now which has increased to around 290 to 300 crores. So one question was how we are planning to reduce over the next 2 quarters. That is one part. And second question was as I see that some 14 crore rupees has been invested for acquiring some 12.31% stake, which is roughly valuing the company at around 170 to 120 crores. So, and as we understand that these subsidiaries are not paying money as such as on today, so we are trying to get things organized. But what is the logic of putting more and more money, and what is going to happen? Suppose today we are at 90 and tomorrow we are going at 100. So what is going to happen? What is the logic behind going and investing more and more into these subsidiaries? That's my question. Thank you.
So thank you, Pranav. I'll take this in two. One is about the increase in debt. Compared to March levels of 263 crores, the total debt, it has increased to 298 crores. So the differential is 35 crores, out of which I told in the beginning, we have taken a fresh term loan for capital expenditure in the BTS in India, which is about 15 crores. And the balance 20 crores is actually the increase in working capital debt in standalone entity. In the subsidiary, if you look at it, actually, it has marginally come down from 156 crores to 155 crores. But again, if you look at the quality of that debt, in terms of euro, the real debt has come down by about 1 million from March to September. But as you know, I have been telling this in the earlier calls also, we had to gross up the factored debt. The factored debt has increased by 1 million, so that compensated. That is why you see the subsidiary debt is at the same level. So the increase in debt is from the standalone, partly 15 crores for term loan, and the other one is working capital. But having said that, we look at the reduction of debt in the second half of the year, because we should be able to generate cash from the operations. Plus also, we are looking at certain contracts where we will be able to get customer advances. So I expect by the year end, our debt level should be significantly down. That's one on the debt. The second question on the investments, as you know, when we invested in this subsidiary, we also took the put option obligations. So the final tax that we bought from management and the employee shareholders in the current quarter is actually meeting the put option obligation which we have undertaken in the beginning of when we started this investment. With this, we have completed all the put option obligations. So there is no more obligation to increase, and we are at 90.1%. Having said that, what is the logic? Even today, we firmly believe that the design services are something that we should be able to, leverage, and then with the offshoring that Nikhil explained, going forward, we expect the margins to improve significantly in the next two to 3 years, and having a 90% will definitely be beneficial going forward. Looking back, it might look we have been increasing the investments in the lossing proposition, but that is more due to the put option obligation that we have taken. So we expect going forward 90% stake will really be good for the company.
Yeah, thank you very much. Just one last question. What is any progress on the JV with Indra?
Yeah, I mean, these are, like we mentioned earlier, we have already submitted a sizable tender in partnership with Indra. But these Government of India tenders which will take a long time for it to fructify. So we continue to monitor and check the progress on this opportunity as we go along. But this is we will just basically need to wait and see when these opportunities progress, basically the next stages of the tender.
Thank you. Thank you very much.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Our next question is from the line of Vikram from Niveshaay Investment Advisors. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, how do you pursue the EMS export opportunity and addition of new customers? Our current quarter numbers were very good. Are the figures at the stand-alone level look sustainable, or will they change? How you look at EMS export opportunity?
Yeah, I mean, like I said earlier, a big part of our EMS business today is export-oriented itself. So while there is a significant opportunity for the domestic market itself in terms of import substitution and so on, which we are looking at, we continue to see a sizable pipeline of opportunities coming from our export customers, both existing as well as new. And this is again driven by the whole China Plus One strategy. We're clearly seeing examples of new customers which are large global OEMs which are taking this decision to de-risk out of China. And so we are quoting those opportunities, and we expect to convert some of those as well in the coming quarters and the time to come. So we are quite bullish about not only the domestic but also the export opportunity in India.
Okay. And which sectors were major driver in this quarter?
In this quarter, like I said, the beginning, from the EMS perspective itself, we had the EVs being one area. Some of the new customers in industrials, or basically clean tech, that's another area. And also some of our legacy customers that we've been working with for a long time, their demands have increased also on the defense side as a result of the war in Ukraine and so on, and increased defense budgets in Europe. So the same products that we've been manufacturing, we have increased demand coming for those as well.
Okay. And sir, any update on our partnership with Rafael Advanced Defense Systems? Give an update on Indira system.
Yeah, even with Rafael, we are continuing to be closely engaged with them, pursuing some specific tender-based opportunities in the EW space. So we are continuing to develop that, and we will be participating in some new tenders which we are expecting in the coming quarters. So it's progressing well, but as I mentioned always, that these are long gestation kind of opportunities, and may take some time for it to come into actual orders. So, but they are progressing well.
Okay. And in call earlier, we mentioned about closing of some two big orders in BTS segment. So these orders are in our standalone entity, not with any partnership, correct?
Yeah, no, these are standalone. They're our designs, our technology, and we have a good visibility on those for the coming quarters.
Okay. And sir, what will be contribution of clean tech and EV in total EMS business? Like the new business which we have added in last 18 to 24 months, I think.
Yeah. I won't give you specific breakdown in terms of these, but as I've said earlier, we add multiple customers in these areas, and typically when we add a customer, we want to be able to achieve at least a $10 million range on annualized basis with each of these customers, and I would say we're not so far from achieving those numbers.
And how is the visibility like? In last call you mentioned one of your client is shifting all manufacturing from China to India. So how is visibility like from here on? If I look from the 2-3 years time horizon, so how is like what they are conveying to you in terms of business side?
All their manufacturing, first of all, so they are de-risking their supply chain, which means that they will continue to source from China, but they want to have a second source destination to source from. So that's the first point. And as I mentioned, those opportunities are strong. They continue to develop. And so the growth that we will see is not necessarily only from those existing customers, which obviously we do expect growing opportunity with some of them. But we are also seeing other new customers with the same theme, same ideas that are engaging with us with the objective to source from India, basically.
Okay. And sir, last one question. What is our capex plan for next 2-3 years?
Like I kept mentioning in the last call also, current year we had planned about 30 crores, of which we have already spent about 20 crores, and that's why you see the term loan of 15 crores. But beyond that, I don't see any significant capex, but for some maintenance capex, which could be about 10 to 15 crores per annum. But having said that, like Nikhil mentioned, we are working on many of the opportunities. Like somebody talked about the Indra, and you talked about the Rapid. If those opportunities click, we may need some investments, but these are very big opportunities. So at this point of time, I have not factored that when I answer your question. So it will be about another 10 to 15 crores per annum. That's all.
Okay, sir. Okay, thank you very much.
Thank you.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I would now like to hand the conference over to the management from Centum Electronics Limited for closing comments.
Thank you. So once again, appreciate all your time and your interest in the company. In summary, as I mentioned earlier, we have seen a strong growth in the first half compared to the first half last year. We expect to continue down this path of both revenue and margin improvements in the subsequent quarters as well as in the coming years. The macroeconomic factors and the demand in general from these different opportunities remain strong for us, and as a result of which, even from an order book standpoint, we see a good visibility coming up. And so in general, I would say quite positive on the outlook for the coming quarters as well as coming years. So with that also, I want to close by wishing all of you a happy Diwali again. May the festive season bring all of you a lot of prosperity, health, and happiness. Thank you.
Thank you. Wish you a happy Diwali.
Thank you. On behalf of Centum Electronics Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.